Cash App's fine print calls some balances not deposit products. Deposit insurance rules were written for banks, not the money apps consumers use. Without a Cash App card, a sponsored account, or sponsoring one, yours lacks FDIC insurance. This is not an accusation. It is their own published disclosure. The problem is the gap between the app experience and deposit insurance. This is what the record actually says. Start with the label itself. FDIC Insured protects qualifying deposits because insurance was written for banks, not apps. That protection activates when an insured bank fails. App failure, middleman failure, and non-deposit balances fall outside FDIC deposit insurance. FDIC deposit insurance simply does not trigger. That boundary matters because an app can look and feel bank-like. You can hold money, move money, and check a balance. Those familiar actions do not decide whether your balance qualifies. The legal structure underneath decides. One describes today's product experience. The other describes a legal backstop for a specific failure. Confusing them turns a narrow guarantee into a broader assumption. Architecture 1 holds a balance that never became a deposit, so insurance never arises. The second uses custodial bank deposits held for customers. Pass-through means insurance can reach them. According to the CFPB, middleman failure can still block access for weeks or months. Those architectures must stay separate. The distinction may never appear beside the balance itself. It sits in disclosure conditions and account structure. The screen stays familiar while the legal category changes underneath, but the covered event remains the same. An insured bank must fail, and every required condition must hold. An app outage is not a bank failure. A middleman collapse is not a bank failure. A records mismatch is not a bank failure. No bank failure. No FDIC payout. That is the reveal. The label names protection against one event. It does not promise uninterrupted access through every company touching the money. It also does not promise every balance became an insured deposit. Now consider someone like Maya Torres. Maya is an hourly service worker with changing weekly shifts. She keeps a small pay float in Cash App. The app feels bank-like during everyday use. She holds only a Cash App balance. She has no Cash App card or sponsored account. She is not sponsoring a sponsored account. Nothing freezes. Nothing disappears. No company fails. Maya simply reads the public disclosure. Under that disclosed condition, her balance is not a deposit product. It is also not eligible for FDIC pass-through insurance. Reading the disclosure changes her understanding, not her balance. That realization is the consumer story here. The app experience answers what Maya can do today. The legal structure answers what deposit insurance protects during bank failure. Those are different questions. The regulatory gap leaves them sitting beneath one familiar label. Deposit insurance rules answer the bank failure question. Separate representation rules address how insurance gets described. Separate record-keeping proposals address how certain custodial accounts get tracked. Different rules, different jobs, different timelines. That patchwork is the real story. Cash App is our disclosure exhibit, not an accused wrongdoer. Synapse is our failure cost exhibit, not Cash App's operating model. Nothing here suggests Cash App shares Synapse's systems or vulnerabilities. The shared point is narrower. FDIC insurance depends on qualifying deposits and an insured bank failing. Everything else requires a different answer. Here is the documentation, beginning with Cash App's own words. Cash App Help publishes an article about FDIC pass-through insurance eligibility. The live page was accessed July 20th, 2026. It says, your Cash App balance and savings. Balance are not deposit products. It also says they are not eligible for FDIC pass-through insurance. That applies without a Cash App card or sponsored account. It also applies when the user is not sponsoring one. With a Cash App card, sponsored account, or sponsorship, eligibility can arise. The disclosure names Wells Fargo Bank, Sutton Bank, and the Bancorp Bank. Eligibility reaches $250,000 per depositor, insured bank, and ownership category. It describes legal ownership, individual, joint, trust, or retirement. That limit includes your other deposits at the same bank. Bitcoin and investing holdings are never covered under this disclosure. Notice the exact word, eligible. Eligible does not mean coverage is already confirmed. The page proves only Cash App's published conditions. Connect that boundary to our last investigation. Synapse's 2024 collapse blocked access to consumer funds. According to the CFPB, consumers lost access for weeks or months. That story involved a middleman and partner bank records. It did not involve an insured bank failing. The new evidence arrived after that collapse. The action ended with a stipulated judgment, meaning both sides accepted the court order. That order was entered on September 12, 2025. According to the CFPB, it identified a $60 to $90 million shortfall in consumer funds. The agency alleged Synapse kept records that did not match partner banks' records. These agency-stated claims were not findings decided after a trial. The CFPB says many consumers still lacked their full balances. Then came the number that changes the accountability story. The stipulated judgment imposed a $1 civil penalty, meaning a government fine. That dollar was not the court's valuation of the harm. The penalty enables bureau access to the Civil Penalty Fund, a government redress pool. The judgment makes harmed consumers eligible for possible fund payments. It does not approve, fund, or prove any actual compensation. The judgment concluded the CFPB's enforcement action against Synapse. It did not close every separate bankruptcy or recovery matter. Now examine the regulatory response. Federal Register and Unified Agenda records track the proposal's pending status. On October 2, 2024, the FDIC proposed record-keeping rules for certain custodial accounts. Covered banks would keep clean, reconciled records under that proposal. Reconciled means the bank's records agree with the customer ledger. This remains a proposed fix for the records problem. It has not been finalized. The comment period was extended through January 16, 2025. On March 3, 2025, the FDIC withdrew 4 other proposals. Those withdrawals included brokered deposit changes, covering money placed through intermediaries. They excluded the custodial proposal. The representation rule followed a different path. Part 328's advertising amendments cover insurance representations and were approved in January 2026. They became effective March 2, 2026. Compliance is not required until April 1, 2027. They address insurance confusion involving financial technology companies and bank partnerships. The record is precise. The record's proposal remains pending. The representation rule is final, with compliance due in 2027. Deposit insurance eligibility remains its own separate question. FDIC Insured was never a promise about your app. It is a conditional statement about specific banks. The published conditions show what the label answers and never claim to answer. That does not make the label meaningless. It makes the label narrower than the app experience around it. Your screen can show a balance instantly. That screen cannot show every legal condition beneath the balance. So here is the practical check you can run right now. First, find your app's own FDIC or insurance disclosure page. Do not begin with an advertisement or search result summary. Second, read every condition attached to eligibility. Check for a card, sponsored account, or sweep program requirement. A sweep program moves customer money among participating banks. Then note which listed products the language covers. Look separately for balance, savings, investing, and crypto. Third, record every partner bank the disclosure names. A possible bank list does not identify your balance's current bank. That distinction affects the insurance limit. The $250,000 limit applies per depositor, insured bank, and ownership category. It includes your other deposits at that same bank. Now state the limit of this exercise clearly. This check reveals published conditions. It does not confirm actual coverage. Actual coverage depends on records and FDIC requirements when a bank fails. That unresolved gap is part of the story. The disclosure tells you the program's rules. It may not identify which bank holds your balance today. The app can feel simple while the legal chain remains conditional. It is proof that user experience and deposit insurance answer different questions. The FDIC's rulemaking record recognizes representation confusion in fintech bank partnerships. Not app failure, not middleman failure, bank failure. That boundary survived every exhibit we examined. Cash App's page stated conditional eligibility. The Synapse judgment showed what another kind of failure can cost. The regulatory record revealed a dated patchwork. The problem was never one company. It is the regulatory gap between deposit insurance and money apps. It leaves a familiar label carrying a very specific legal meaning. You now know what question to ask. Not, does this app display FDIC language? Ask, what balance qualifies, through which bank, under which conditions? Then ask, what happens if something besides that bank fails? Someone like Maya can read those conditions tonight. This investigation began where our previous one ended. There, a middleman failed while partner banks remained open. The result exposed exactly why the bank failure boundary matters. Watch your banking app said FDIC insured, then $28 million froze. Next, it shows the failure that made this fine print impossible to ignore.